well known to many people, BlackRock, is because of its management of retirement accounts in particular, but much broader than that. So speaking of the election, Rick, the description of this session talked about a prolonged interest rate cutting cycle, which we kind of took for granted until last week, right? And it seems as though markets certainly have turned expectations on their head. So what are we looking at now in terms of that interest rate cycle?
So the first thing I think it's interesting, by the way, thanks for having me. This is a cool event. Much appreciated. So think about where we were a few weeks ago. It's pretty remarkable. The narrative was hard landing, economy slowing, consumers falling off a cliff, et cetera. They priced the Fed down to a 270 funds rate by the end of next year. We're almost at 4% today. So it's interesting when I hear people say, well, rates are coming down. It's like, my screens don't show that. It's pretty remarkable how much things have shifted. So let's think about where are we in terms of from a foundational point of view. Coming into this election, the economy is in pretty good shape. We printed 3.0% GDP in the second quarter, 2.8% in the third quarter. Didn't feel like hard landing. Consumer is, and you could see that in the earnings reports, consumer's still doing pretty well. Now you have this election, now you have a whole new playbook around the red wave. And quite frankly, the dispersion of where interest rates could go has just widened out. And by the way, I'm going to answer the question, but I will say one thing. Anybody who says they know, so you think about, and Mark talked a bunch about this, tariffs, what it means for growth, the strategic decoupling that could happen. By the way, you've got somebody sitting in the White House, i.e. Elon Musk, that's pretty good at automation and innovation and productivity enhancement. Like, we're going to go through the next couple of years of an extraordinary sense of change. And anybody says they know what that's going to look like is lying or is arrogant. What do I think has happened? If you take the rate, so in my base case for like 10-year treasuries, people like to hone in on 10-year treasuries, it tends to follow nominal GDP. Nominal GDP, and if you watch, you come off the curve of nominal GDP if you have massive fiscal stimulus or monetary policy, but you generally come pretty darn close back to it. So if you said where we were a month or so ago, you could have assumed real GDP at about 1.5 to 2 and inflation of 2-ish, maybe a little higher. And I think, quite frankly, all the improvement in inflation has happened. So that gets you about 4. Now with this election, you say, gosh, we're maybe tariffs of significant magnitude, although I think ultimately won't be nearly as pervasive as is being chronicled. But you're going to unleash a fair amount of deregulation, growth initiative, and gosh, maybe we got to take our nominal GDP forecast up a bit, whether that comes from inflation or growth. And by the way, tariffs tend to lift inflation, but they dull growth. So you got to think through, there's a balance there. Listen, I think the range of the 10-year, if the 10-year was in a 3.5 to 4.25, I think you got to lift it. Let's say 50 basis points. And I think you got to widen the range a bit, 4 to 5. And then we got to see what these series of initiatives come from there to determine where are we going to be relative to that. And by the way, I could lay out my base case. Growth is going to be stronger. And then it's going to be, we were on a trajectory where inflation wasn't coming down anyway. Maybe we have a little bit more inflation before the productivity enhancement really kicks in.
So as you said, we're all still trying to sort of guess at exactly what the fiscal policy is going to look like. We've gotten some clues into other parts of policy over the past few days with some of the reports of who could be appointed to the administration in various roles. We don't know who the Treasury Secretary will be yet, for example. What are you going to be watching to figure out where all this stuff is going?
So, the biggest thing, I do a lot in equities, but also, fixed income is a bigger part of my remit. Listen, I think the debt in this country is, and how they address the debt in this country is going to be the most pervasive.
Well, they don't seem to be addressing the debt at all, Rick, at this point.
I don't, I will say markets, I say this, I've said this on the show with y'all, I think markets tend to react to the shark closest to the boat. The shark on the debt dynamic is not going to be next to the boat in January, February, but it is going to get next to the boat sometime. I don't know if it's the latter part of 2025 or the beginning of 2026, unless they address. And by the way, unless they address the size of the spending dynamics, the amount of debt we're issuing, and then obviously inflation relative to that. Now, I've heard the president-elect talk about things around energy and dereg and how to bring cost and inflation down. That's a really big deal, particularly for the long end of the rates market. But they have to address. And by the way, if the right people are in charge and running it, you could build a lot of confidence in, okay, there's a plan. It doesn't have to be executed, and it can't be executed in the next 6 months or a year, but there's a 5-year plan. We can debate, what you put in place when you leave off or when you leave office, how that changes. But you've got to put in place a plan that people feel comfortable that we're going to get the debt under control. And by the way, it's not just the debt, it's the debt service. And I know I say this all the time. We used to issue Treasury bills at 0%, 1%. We're now issuing $400 billion a week. And by the way, some weeks significantly higher than that, at 5-ish. And so what happens is the cost of the debt in this country just keeps going up, so it eats up all the discretionary spend in the country, and then you have no fiscal flexibility. And for an administration and Congress that wants to execute change and evolution, if you have no fiscal flexibility, pretty hard to do that.
So I guess tease out a little more what the shark closest to the boat will look like if the debt gets to that level, if the debt servicing costs are going higher, if we don't have that flexibility. I mean, the debt's been growing, and it hasn't been a problem, right? The market, we've seen investors continue to buy U.S. debt. When does it what would force it to become a problem?
The biggest, listen, I talk about it all the time, long end interest rates are where you have the volatility and the dispersion, because you try and think about where we're going to be longer term. What is inflation going to be? The long end of the yield curve, to me, is where you got to be really, really careful and really thoughtful about it. And what I worry about at times, and again, it's all about, I think people underestimate confidence in markets and how, if you think about what's happened to the equity market over the last, people have confidence and they think, gosh, maybe earnings are buoyed a bit. I feel pretty good about it. My PE ratio is high, but gosh, if I buoy earnings, you got operating leverage on a good economy, pretty good. You got to create confidence, because the back end of the yield curve, and we go through auctions, sizable Treasury auctions, almost every day. You got to instill confidence, and I watch these auctions, particularly further out the yield curve, like a hawk. And there's going to be periods of time where people say, you know what, I don't feel great about it. I'm gonna pause. And there's a lot of talk about bond vigilantes when people come in. You got to be careful, and so we're going to watch those auctions. And those auctions give you a really good indicator. And by the way, foreign demand.
Right.
We used to rely on foreign demand, China, Japan, et cetera. Long discussion. Japan's buying less. Long discussion about JGBs, cross-currency swap. China's definitely buying less and going to be funding more of their domestic infrastructure. So we got to fund it largely domestically. And so you got to watch these auctions.
So watch the auctions for number of bidders,
totally,
yield that they're getting, and that foreign investment
totally.
In the U.S. If those things drop off, then what? How does that scenario play off if you start to see a drop in demand for U.S. debt?
So I also have to shift to the more encouraging side of things.
We'll get to that. First, give us the worst case here.
So. Listen, I think what happens, the U.S. is a reserve currency in the world. I don't think people understand when you look at, roughly 2/3 of the world's transactions, liabilities are in dollars. The form of collateral in the world is Treasury bills. When you dilute reserve currency status, let's say we go down the scenario we talked about, and you don't see enough buying of the debt, well, it goes right on the Fed's balance sheet, a la, what did the Bank of Japan do when you saw yen go from 100 to 166? That is not a scenario you want to have play out with the reserve currency in the world. Think about how many countries are pegged to the dollar, let alone transactions, et cetera. So, like I say, I'm painting the tail risk, and by the way, not to overstate it, I think it is the tail risk that we have bigger issue around it. If you put in place a set of measures that instill confidence, I tell you, the U.S. economy and the U.S. investor base, and I'll throw out one number that'll blow you away. There's roughly $220 trillion of net worth in the United States today. So you take the debt, and we talk about the amount of debt. You've got an immense buyer base that can buy treasuries. We're watching it in credit. We're watching it in equities. So your ability to deal with these issues, the asset protection, people say U.S. should be downgraded. The asset protection and the ability to enact measures within the U.S. to support that debt and other things is pretty extraordinary.
So what is that? Okay, so that's one risk with the sort of deficit increase policies that we think might be put in place. What would be the best case scenario? Would it be, Mark Rowan just talked about outgrowing some of these concerns? Is that the best case scenario?
So I'm just going to sit where I think what could happen and what I think you can get really excited about. The only way you bring the debt down, or the only way to deal with this, you got to outrun the debt, because you can't take it off the books unless you do a wealth tax as a new magnitude, which I don't think is going to happen. I'm certain won't happen in the near term. So how do you outrun it? Nominal GDP has to be over the cost of the debt. I've watched Italy for years. Very hard for Italy to delever because they don't grow fast enough. You don't have enough nominal GDP. U.S. is at a point in time, much of what Mark talked about, you have this extraordinary ability to grow. The amount of money in infrastructure we're going to see, the amount in data center, energy, cooling is extraordinary. And so the ability to actually put in place initiatives to promote that growth forward, keep nominal GDP. If we keep nominal GDP, let's say it's 5, and we could debate, do you get there from inflation, you get there from growth, and probably some combination thereof. If you operate at nominal GDP of 5, and then you keep the cost of the debt, and this is the Fed, part of why I think the Fed still's got to get the rate down a bit. You could operate, if we're running at 3.5 to 4 cost of debt, you slowly bring the debt down. By the way, it's pretty incredible. You think about how much debt and the size of these debts the last couple of years, but it actually hasn't created a pernicious dynamic in terms of debt to GDP. Why is it? Because we grow so darn fast. As long as you keep promoting the growth, as long as you outrun the growth, then we'll be okay. And then we got to deal with, things like mandatory spend in this country, retirement age, et cetera. You can create a plan that you can get your arms around and say, gosh, this works. And what Mark said, the amount of money that's in private equity, private capital, public capital that wants to get in, I think about pension funds, life insurance companies, that want to fund long-durated assets, that could be debt or equity, is pretty extraordinary. So meaning the point in time couldn't be any better. The environmental condition, the balance sheet needs to be fixed.
I want to talk about equities for a moment, because you have a lot of equities under your purview also. We've heard obviously equities have been flying the past week or so, and the forecasts keep going up. So Evercore ISI's Julian Emanuel says we could see 6,600 for the S&P 500 by the end of next June. We talked to Ed Yardeni on the show yesterday. He says 7,000 by the end of 2025. Do those numbers make sense to you?
So, listen, I don't love the multiple of equities. I think you're counting on a fair amount of growth, but something has evolved. If you believe, equities, there are two things that drive equities higher, and I think will drive them higher. I don't love the multiple. I'm long. I use a lot of convexity in my book using options, and then we've actually, including the last couple of days, when volatility comes down so much, like we're rolling some call options at 11 and 12 volatility. That's like nirvana for a manager. If you can create your equity in a more convex structure, that is nirvana. So I'm long, and listen, I think what happens is there are two things at play. One, I think the multiple's high, but if you think the E in PE is going to be significantly higher, you get that multiple to a reasonable level, and we talked about the amount of spend on infrastructure. Listen, we could debate small cap, mid cap. I think the places that are going to spend in this space and the revenue and the capex driving that revenue is pretty impressive. The second thing that I think people underestimate, the technicals are crazy for equities.
Crazy good?
Crazy good. And I know we're talking about on your show. You think about today, there's $9 trillion in global money market funds, there's $23 trillion, and you include deposits, some of that's pledged. And then and you think about the amount of money that comes in a 401k, wealth, salary, X% goes into equities, and there's no sellers. And by the way, the big companies buy back $1 trillion of their stock. So you shrink the denominator because they're buying back a bunch of their stock, and there's no sellers. Like when there was an IPO, people were like, oh my God, there's an IPO. Well, relative to the size of the markets, there's nothing. There's who's the natural seller? And I've learned over my career, the technicals win. Even if you believe in the fundamentals, the technicals win more, and that is super powerful. People want myself included, want the multiple lower, but boy, it's pretty hard. If there's no egregious piece of news, geopolitical, et cetera, the natural migration is to higher prices.
Well, okay, so if you talk about on the bond market side of things, if one risk is sort of a buyer strike, so to speak, what's the risk on the stock side? I mean, you mentioned,
Yeah.
geopolitical. Geopolitical hasn't made a dent in equities.
Pretty amazing.
In a long time.
Yeah.
So earnings continue to grow. Revenue continues to grow.
Yeah.
You've got maybe better, fiscal policy that could be helpful for stocks.
Yeah.
What could go wrong then?
So can we go back to the debt discussion?
Sure.
So that's the one. Like if you said to me, like what keeps you up, I don't do a lot of sleeping, but what keeps me up at night, the first thing is, listen, you got to watch the geopolitical, keep an eye on it. Like you say, people tend, unless it is huge, people say, okay, I've seen this before. And by the way, I've lost more money hedging over my career for geopolitical. And unless it's something dramatic, it doesn't really influence. Listen, how we play out this quote unquote strategic decoupling with China is going to be significant. Are we going to tariff? And my sense is not. There won't be massive across-the-board tariffs. There'll be some form of bilateral negotiations. But, tariffs do reduce growth. They bring up inflation. They do reduce growth significantly. We got to keep an eye on that. My sense is this administration will be pretty thoughtful about it, I think. And then the other is, listen, I just think we got to deal with the debt thing. If you took the discount rate significantly higher, if you took the cost of financing for companies significantly higher, that you dull cash flow generation because the cash flow gets stuck at the debt, like those are the risks, and that today is what I think is out there.
And you mentioned the tariffs could be a bit inflationary. I mean, a scenario you're talking about with bond vigilantes, et cetera, that also could be inflationary. Totally. Yes. So, I mean, but how do you figure out how do you sort of game it out and figure out the probabilities at this point?
So I don't. I mean, by the way, the bond vigilantes, don't sort of inflation, but they certainly could press the rate up.
Right.
And so how do you assess that? And the way I think about it, when we try and build balance in the portfolio, is you think about, gosh, particularly today when volatility comes down, I'm the happiest person in the world because now I can run my equity portfolio and build a ton of downside into it. So that is one. Two, I love owning yield. And you don't have to go out the yield curve. I mean, credit, Mark talked about it. I've been doing credit for I've been doing credit for a really long time. I've never seen it. So post-COVID, companies term their debt out. They have no maturity wall, many of them. And you got a decent economy, good free cash flow, cash on hand for many companies. I just love owning yields, stay shorter on the yield curve, just keep clipping coupon in the front end, keep my interest rate exposure down, and you create balance in the portfolio. If your equity has got some convexity, some hedging to it, and then you're creating a lot of income on your fixed income side. By the way, using Europe as a place to lend into is fantastic because Europe's not going to grow as quickly or significantly slower than the US. You watch what's happening in Germany, et cetera. Europe is a fantastic place to get income, take some interest rate risk, and so just create more balance. And by the way, like Mark said, more and more people are going to use private markets. And we do a lot of bespoke financing, and I think the terms are phenomenal today.
Right.
But you got to create balance and create a lot of liquidity in your portfolio too, because stuff happens, I've learned.
All right, quickly, last 30 seconds. A year from now, you want to take a stab at where the 10-year is going to be?
No. Okay. Listen, I think if you buy into this nominal GDP, I don't think it moves very far from here. With my would I err on the side of maybe a bit higher, given but we got to see what comes out, tariffs, et cetera.
I had a feeling you would answer that way.
Sorry for being.
Fair enough. Rick Rieder, thank you so much for being here. Really appreciate it. Thanks.